So we'll start off with fixed income, and the most important bit in fixed income is to know the different features that are a part of fixed income, right? Issuer, maturity date, the par value, the coupon rate, and then you have the currency, right? That is the denomination in which the coupon and will be paid and the principal will be paid. So issuer gets the money. Any party willing to get into the contract, the end date, the issuer pays the money, but this money is called principal, right? If the bond makes fixed payments, that means the issuer keeps giving payments in between. This is called a coupon bond, right? So if you see a coupon rate, let's say 10%, 10%, and 10%, so the issuer will have to pay this 10% to the party that actually holds the bond. The currency denomination is pretty easy, right? Dollar, is it rupee, is it pound, is it yen? So any of these currencies or whatever it is also needs to be set at the beginning of the contract. I left point number 3 on purpose. Par value is, so for example, a $100 bond. This is the base value. So when someone says 10%, bond is this $100 bond is trading at 102. So coupon rates are always quoted with respect to the par. If a bond is trading at, let's say, 95, and 95 is the trade value. If you're getting the bond at 95, you're getting the bond at a cheaper rate. That means your rate of return increases, right? This is called a discount bond. So when you hear the term premium bond, it means that you have to pay more to get the bond. So that's what premium is about, right? Okay. Now let's understand what are the different types of issuers. National governments, corporations, banks, state government. National government, state governments. The CFA is a little more smart thing. So you just need to know, okay, these are the different types of issuers, right? Bond maturity essentially means life of the bond, right? Matures in 5 years, it has a 5-year life, etc. So this is also known as the maturity. This word is also known as tenor or term to maturity. 3 categories. You have money market and capital market, right? Money market securities have maturity less than 1 year. Capital market is greater than 1 year. And money is always something that is spent in the short term, right? Right? Whereas capital, it's more long term. Perpetual means no maturity. Okay. Now, when you talk about coupon, of course, there are different ways to structure a bond. So when you pay a coupon, at interval, this is called a conventional bond. Zero coupon. So here, when I say zero coupon, it means that I'm not going to pay you any coupon, right? There are no fixed interval payments, right? But there are overall 2 kinds of coupons. Here there's dollar, here it's zero. Whenever you speak about a bond, like we studied, there are 2 parties, A, B. First, you have the issuer of the bond. Second, in simple language, I mean, these guys are the lenders and they're the borrowers. When money is exchanged, they get into a contract. This contract is called a bond indenture. By the way, this bond indenture can also be called a trust deed. Now, in terms of what they need to do, this bond indenture will then have covenants. Covenants can be negative or affirmative. So basically, negative covenants are restrictions. What you cannot do. Let's say your company A, you have one security, cannot pledge to many. So negative covenants protect the decreases credit risk. What are affirmative covenants? Basically, compliance. What you must do. So, for example, timely valuation of the collateral. Yeah, that's another one. Payments is another one. So, I would say payments. That would mean interest needs to be paid on time. Timely valuation would ensure that your collateral is also it has good value, right? You can't just evaluate your collateral once and say this is going to have the same fair value throughout forever, right? So you need to constantly revalue that as well. When you hear secured bonds, etc., all you have to know is obviously secured bonds are going to be more secure. And literally, the textbook says secure bonds are more secure. Asset backing the bond. If it's secured, it's a senior bond. If it's not, mezzanine, junior, equity, tranching essentially represents different levels of claim. So mortgage-backed security would mean that I pool a set of assets, and asset-backed security when I sell it again. I can package all of this and then sell it out to investors. Typical bond cash flow basically is you get small cash flows here and then you get the principal back, right? So this is a typical bonds cash flow. It's called a bullet structure. That means you get a big payment at the end. What are these small payments called? Interest. The other structure type is amortizing loan structure, right? What's an amortizing loan structure? It's equal payments. Amortizing loan basically means that you get equal payments. So where house loans, etc., the mortgage payment, the payback, you take a house loan, you put it on EMI, you give an equal payment every month. That is principal plus interest every month, right? A portion of the principal plus interest gets deducted every month, but in equal payments. The key here is equal. But the key in bullet is big payment at the end, large at the end. There's one more thing called partially amortizing. What is partially amortizing? It's simple. Part of the loan is equal, the other part is bullet. So you can see the partially amortizing structure combines bullet, amortize. That's it. Sinking fund provision. What is that? What do you think a sinking fund is? Sinking plus fund. So a certain portion of the capital, or it can also be principal, is paid back periodically.